You can't predict the market until you can read the market, correct? If you can't read what the market's doing without any prediction, how the hell are you supposed to predict anything? So reading the market is the single most important ability from a trader's point of view. Can I read the market? Can I see what the market read is telling me? And based on the market read, can I start predicting if I see the same starting points for the future? Can I start predicting the future? Of course you can. So when you're trading the bonds, can I start predicting a buy on bonds because I start to understand a bear flattener, for example? Yes, I can. I can start then predicting what the bond is likely to do in a bear flattening situation. So long as I know where the discount is. Do I need to know where the discount is? Yes. Is that a prediction or a statement of fact? Well, a discount is a statement of fact, isn't it? So the fact I can then decide what a discount price is on bonds, and then I can predict an outcome from that discount price based on bear flatteners, I can make a living trading bonds almost entirely based on that two-sentence narrative right there. There is a lot of easy stuff in trading. And I think an awful lot of retail traders pass up on the easy stuff way before it's time to pass up on the easy stuff. They think that trading needs to have a lot more complication to it, and it doesn't. So trading the easy stuff should simply be about understanding what you're seeing. Not what you think you're going to be seeing, but what you're seeing right now. We covered that in the accumulation. Am I seeing increased volume or decreased volume? Am I seeing the right signals that are coming into this trade area? Am I seeing this as a possible top edge up here on the soybeans market? Am I seeing a drop in volumes? Am I seeing these things that are telling me that this is now going to be a top edge sell? Yes. I'm not predicting that it's going to be a top edge sell, but I'm seeing the cornerstones. I'm seeing the flags waving in the background that are telling me that there's a very good chance that this is going to be a top edge sell. It might not develop. The value might increase, improve for the buyers. The volume might start picking up on the buy side again, in which case I'll start pulling away my offer. But again, that's going to be an observation, not a prediction. The vast majority of your trading is observation. It's not predicting anything. You don't need to predict the market to be successful. You just need to trade the reality of what is actually going on. If you can get to that elevated world of being able to predict what's going to happen next, then of course that opens the door to millions of dollars of profits if you can get into that area. But that is a rarefied atmosphere, guys. There's not that many traders that can predict the market with accuracy. But there are a lot of traders that can trade the market with accuracy based on what they are currently seeing. And this is what you need to get to, at least that point first, where you can actually start saying this is what is happening in terms of fast and slow, in terms of volume, in terms of tape reading skills, in terms of order flow. On that bombshell, we're going to finish off today. We are going to be covering quick starts next week. Kim wants it to be next week for the quick starts. And what happens in the quick starts? Why is the quick start valuable? Well, because obviously we're going to build out the framework for every trade we take, every single trade we take, based on relative value, based on an understanding of why the relative value that we use is relevant, based on fundamentals, technicals, order flow, and relative value. So instead of approaching the market from the market maker's perspective, the market maker's perspective fits into the quick start. Why does it become a buy? Where does it become a buy? When does it become a buy? And these are the questions we then answer in every single market that we trade, on oil, on natural gas, on gold, on bonds, on the beans, on the NASDAQ, on the FTSE, on the Forex markets. So these are the questions that we start answering next week. And we do one market per day so that we get it cleared as quickly as possible, one market a day. And then we get to a point where you can actually look at your markets as a professional trader, like we did on the soybeans here, recognize that the crush is getting crushed and start buying into liquidity, technical low price liquidities. Buying into the technical low price liquidities here results in a monstrously profitable buy side trade. Why did we buy here? Why did we take that buy trade? That's what we answer in the quick starts. It's not just because of the profile that was developing out this beautiful low price edge. It's because of the crush spread and the dollar China coming in at the same time. It was also the time of the day, the London market open, where we're needing liquidity to buy into. So instead of you making a mistake and coming into this market as a buyer, for example, up here, when we haven't had any liquidity, we know that we need liquidity, so we know it has to come down to this price, and then we take our shot. We end up bottom ticking the soybeans today. Bottom ticking it. So bottom ticking the soybeans for a monstrous profit of 15 full points, way above one standard deviation. There's no other trade desk in the world outside of the professionals that would have known that that was the perfect trade at the perfect price, but we did. You guys did. If anybody's done soybeans, you know exactly that that was the perfect price for you to buy into. So you can see that there is a massive edge to understanding each of these markets. It doesn't mean you have to learn every market. And I know this is a big problem for retail, that they seem to think that they need to know about every line on every market with no intention of trading any of them. But you've got to learn your market. First and foremost, you've got to read your market first and foremost. Understand how it works, understand how it moves, understand when it works, understand when it moves. And from that, you can start to build your strategy around it. But until you've got the components, the pieces of the jigsaw that build strategy, you can't build strategy because you don't know enough. You don't know enough about strategy to build strategy. And again, that's where retail traders fall apart, is they try and build strategies based on massively incomplete information or even false information. And they wonder why, when they force fit these strategies, when it makes 99% profit on a force fitted back test basis, that they try it live on the right hand side and it simply then loses money and then loses more money and then loses more money and then loses more money, and say, this doesn't make any sense to me. It made 99% based on a force fit back test. Yeah, because you force fitted it on a back test. It has no reality on the right hand edge. Stop wasting your time. So when you look at the marketplace, you should be coming in with the knowledge of the fundamentals. You should be coming in with a knowledge of the liquidity required to satisfy the fundamentals. You should be coming in with a knowledge of what drives your fundamentals, or what is it driving as a result of the fundamentals, and how the intermarket analysis plays between those fundamentals. That dance between bonds, bond curves, and equities, the dance between bond curves and inflation, the dance between inflation, bond curves, and gold prices. Without that, you're always at a massive disadvantage versus somebody that knows how to trade these setups, that knows that the bond was a buy this morning at the very low edge price. Anyway, tomorrow's another day, so the quick starts will not start, Kim said, until Monday next week. I think that the times will be synced. I think it's only a 1 week difference now this week, but the times will be synced back again next week, and we'll be back to our normal schedule. And we'll be doing, on the 4 o'clock session, we will be doing one market per session, until we've covered all the markets. We will not be moving into anything else. We'll be covering every trade that took place that day in that market, so that you can understand it in a little bit more detail, candle for candle, price for price, all the way through next week. Anyway, I will see you guys tomorrow, I'm going to say in the meantime. And if you did just join us, by the way, for the workshop, and this is your last day in here, I hope you were able to get something from it. I hope you were able to pick out some of this. And the most important thing about trading from the dark side is an observation, like I touched on already. An observation that, if you can get your observations right, you are a very, very substantial further forward than you were before. By recognizing, for example, the arrival of volume on gold. The arrival of volume is nearly always a distribution, not an accumulation, a distribution. And from that, you can find these accumulations. But it's not just on the gold. It's on the soybeans, this very low volume accumulation into this high volume distribution. allowing me to understand that this market is very bullish to a point. And then when we see the volume dropping, this is the end of the distribution and possibly the beginning of a short accumulation. Well, we need to see that happening. If we see it happening, we can make some money. We can make some money. Anyway, I will leave it with you at that stage, and we'll be back on this market next week. In the meantime, I will say adios amigos, arrivederci, auf Wiedersehen, sayonara, tutsins, tak skado, dos vidania, and spasiba. In the meantime, ciao for now, guys.